Yes, sir.
All right. Thank you so much. Thank you for the confirmation. All right. So let's start the class. Others will join. We've missed so much due to a lot of hiccups I had and one or two inevitables. So please pardon me. We need to start our rush on time. All right. So we're looking at chapter 11, audit-related services. And the chapter has some significant areas the examiner tests. And we'll be looking at some of those concepts today on audit-related service. And I hope we're able to round off this class today, hopefully. So by way of the chapter contents, we'll be looking at first the learning objective. We'll now move to the learning outcomes. Then we'll look at review engagements. After review engagements, we'll now look at agreed upon procedures, even though we've looked at some of that in chapter 1. Agreed upon procedures, compilations. Please pardon me. This place is quite cold. Cold has started here, so I'm a bit under the weather. So pardon me. I sneezing once in a while and all that. All right. So the agreed upon procedures and compilation engagements, we looked at that a bit in chapter 1, but we'll be blowing it up in this chapter 11. We'll also look at investigations. And we'll also look at liquidation and bankruptcy. And we'll end the class, hopefully. We have a lot of information here to work with, and some of the past papers tested significantly some of the concepts here. So we'll need to align properly and understand how to navigate this chapter and also the questions that may be tested by the examiner. All right, so let's understand the concept first, because the objective is to help us review engagements in accordance with international standards on review engagements 2400 and 2410. Very important standards. We need to understand how engagements review work in line with these standards, and also related services engagements such as AUPs and CEs. AUP speaks to agreed upon procedures, and CE speaks to compilation engagement in accordance with international standards on related services 4400 and 4410. So for related international standards on related engagement services includes 2400, 2410, and for related services 4400 and 4410, which the examiner brings once in a while in his question. So please take note of it and let's align properly. So at the end of the chapter, at the end of the chapter, readers should be able to describe the objectives and conduct of review engagement in accordance with the international standards on review engagements 2400 and 2410, and also describe the objectives and conduct of related service engagements in accordance with international standards on related services 4400 and 4410. Please take note of these key standards. The examiner brings them very, very, let me say, not too frequently, but then he tests them once in a while. Also, we should be able to understand and discuss after this class investigations and the necessity for it and the stages involved in every investigation, and what are the differences between statutory audits and also investigation. We should be able to understand that after this class. Then we should be able to explain the basic principles of a company's liquidation and bankruptcy around review engagements. So that's the outcome and also the objective that we'll be hoping to achieve in this class. And I'll be running, but then please, let's try to understand some of these concepts. And if you have a need, you have a concern, you have something, a thought that strikes and you need clarification, please go ahead, interject very freely, raise your hands, and let's get your questions, your concerns quickly, and let's address them. All right. So let's look at the first unit under the audit-related services chapter. So we'll be looking at the first unit. We'll be speaking to audit and audit-related services. So we'll be looking at the first section, and it will be speaking to the distinction between audit and audit-related services. As we know, we are aware, but by way of recap, an audit is a high assurance engagement aimed at expressing an opinion on whether financial statements give a true and fair view in line with the applicable framework. Principally, the guide for this definition comes from ISA 200. An audit is provided, or it's an engagement that provides high assurance, reasonable assurance on expressing an opinion on financial statements in line with the applicable framework, whether IFRS or the US GAAP. And this helps to give assurance to users of the financial statements on whether financial statements provide a true and fair view. It provides reasonable assurance because the highest level of assurance you could provide under ISA is reasonable and not absolute. So, in contrast, looking the other way around, audit-related services provide limited or no assurance and are generally less extensive in scope. This is very important for you to take note. So, audit are reasonable assurance provided services, while audit-related services are limited or no assurance provided services. And they are generally limited in scope and less extensive. But audits are generally extensive and very broader in scope. So take note of that. These are key definitions and concepts you must understand to be able to attend to very serious questions the examiner may bring. So, speaking to audit-related services, they help management or third parties make informed decisions without the full scope of an audit. So, audit-related services are restricted in scope and areas in the sense that management could ask for specialized reviews on specific areas of their operations, their financials, their strategy. Any area could be of interest to management, and they could ask for reviews and audit-related services to help them decipher and comprehend and also get some form of limited assurance on what is going on in that particular area of interest to management. All right, so we have types of audit-related services. Number one, we have the review engagements. We have review engagements that provide moderate or limited assurance that the information the assurance provider or the practitioner has reviewed is free from material misstatement. So this kind of review, for example, you want a chartered accountant to come and check your IT setup. Help me check the IT setup. Why are internet services going off? Why is IT system, internet always down? So a chartered accountant or an IT provider, maybe a CISA, a Certified Information System Auditor, that is also a chartered accountant, can come to provide that kind of assurance limited service to management on that IT area, specialized area, to show that information there and specialized issues could be resolved by his limited assurance and provision of recommendations and conclusions from his review. So that's a typical scenario or an example I've provided around an IT area. And the management could also ask for a review around a particular area of the financial statement, maybe sales. He could be asked to, a chartered accountant could be asked to come and help us review our revenue for 1 year. How did we perform? Was revenue recognized well based on the IFRS and the cash, the credit, the various forms of revenue recognition? We need you to come and help us check it in line with IFRS 15. And that could be done by that chartered accountant, and limited assurance could be provided to management on that very clearly. So that's an example of a review engagement. And it involves inquiry and analytical procedures, but not detailed testing in forms of an audit. Excuse me. It involves inquiry and analytical procedures, but not detailed testing and broader coverage like that of an audit. So, for example, a review of interim financial statements before year end. Interim financial statements could be prepared by management, and a practitioner could be called, a chartered accountant, to come and help them review it before the main full year financial statement audits is carried out. It could be a first level check to ensure that there are no errors or issues in the financials before the main audit, or they may be for another reason best known to management. But then this is a typical scenario or an example of a review engagement. So a review engagement could be provided by a practitioner to management on limited assurance or no assurance. Just give us your professional perspective on this, and that could be management's request. Number 2 is AUP, agreed upon procedures. Management or the owners of a company could specify exact procedures to be performed on particular processes or SOPs or policies just to enhance their systems. So agreed upon procedures, a practitioner could be engaged to report on factual findings on a particular area of interest to management without giving an opinion or conclusion. So for example, a practitioner could be engaged to verify stock quantities or confirm bank balances as instructed by management. So these are typical scenarios and examples of AUPs. So for compilation engagement, a client or management could engage a practitioner to prepare information. For example, prepare financial statements, tax computation based on the client's data. So for example, a company does not have a finance manager or an accountant. They just carry out transactions and collect receipts, post invoices, do POs, but they don't have the IFRS knowledge of how to prepare financial statements based on that framework. So that could be a compilation engagement where they will involve a chartered accountant to come help them do this with the data they have. So this kind of services, there are no assurance, is not an audit, it's an audit-related service. No assurance is given, only presentation quality and compliance are ensured. So presentation quality in form of the applicable IFRS is complied with, and also maybe tax remittances and preparation of tax returns are provided by this practitioner. So for example, preparing year-end accounts for a small business, a sole proprietor business, from its record. So a sole proprietor may not have an accountant or a bookkeeper. It could involve a chartered accountant to do that for him, and that could be a compilation engagement. Very key. So take note of it. So for the summary of related services, we have review engagements that provides limited assurance. We have AUPs that provide no assurance, just factual findings, and we have compilation engagements, no assurance, just preparation of data only. So the core distinct summary around these three is that an audit provides high assurance, reasonable assurance on the opinion and the true and fair view presentation of a financial statement. That's an audit. But audit-related services provide no assurance or limited or moderate assurance, and also factual findings or preparations of data for clients. So those are the principal differences between audit and audit-related services. All right, so any questions? Any questions? All right, I believe the slides are very clear. I took so much time in trying to understand because most of the concepts are very, very complex. It's easy, it's not hard to understand. I had to take some time to really go through the slides and prepare it in a very comprehensive manner that I will understand. Yeah, and if I'm able to understand it, I'll be able to communicate seamlessly with my audience. Somebody said, if you cannot teach an 8-year-old a concept, then you don't understand it, which is true. When I read through the study text at times, some concepts are not too clear. So I have to put them in my own words, also use AI to some extent to help reduce some of those technicalities into decipherable chunks for us to understand. So I believe it's clear, but if it's still not clear, please feel free to interject or raise your hand and let's clarify some of these little concepts. All right, so section 2, look at types of review engagement. Now, like we've spoken about review engagement in the first section, review engagements involve the practitioner providing limited assurance. We've said that financial information is free from material misstatement, but not reasonable or high assurance. Most of the assurance here and the data provided or the data reviewed is less detailed than an audit and relying mainly on inquiry and also analytical review, not test of controls or substantive testings in detail. So review engagements are lesser in scope than that of audits. So we have some types of review engagements around. Number one, attestation engagement. A chartered accountant or a practitioner reviews information prepared by management and expresses his conclusion on it, not opinion, take note. He expresses his conclusion by attestation. He's attesting to the fact that this information I've prepared, this is what I've concluded on its outcome or on the process of the data provided to me and what I've given you as an outcome. So a practitioner reviews information prepared by management and expresses his conclusion, his reservations, his thoughts on it. So, for example, reviewing management's prepared financial statements to conclude whether they are plausible, whether they are in line with IFRS, whether they are in line with the applicable framework. So that could be a review engagement. Management has prepared financial statement. They call a practitioner not to come and audit it, but to come and check. Did we provide it in line with the applicable framework? Did we prepare it based on IFRS, based on a local GAAP, or based on the US GAAP, or the applicable framework of that jurisdiction? So that's an example of a review engagement which a practitioner could help management provide his conclusion, not opinion now, his conclusion on. Number two is we have another type of review engagement on direct reporting engagement. Management or a client could involve a practitioner or a chartered accountant to collect information directly and provide a report in their own name without relying on management's assertion. So direct reporting. A practitioner or chartered accountant is representing management. So he collects information directly from source and provides a report in management's name without relying on management's assertion. So, for example, a chartered accountant could review financial data compiled by the auditor, not management, to report directly to regulator. So, for example, a chartered accountant could pick data from auditors of a company, not the management now. Auditors of a company have audited financial statements, so he picks that report to speak to tax authorities like a consultant to say, okay, this is what has been prepared and these are the tax returns that I'm speaking for my client. So that is direct reporting, not on management assertion, but based on data compiled by another practitioner. So that is what direct reporting engagements speak to. So in understanding the concepts, attestation a review of information from management by a practitioner, while direct reporting speaks to reviews based on the auditor's own findings and the practitioner using that same data to report to either regulatory authorities or demanded by external reviewers. Very important. So you could use this mnemonic to help remember. So the essence of this is that both review engagements around direct reporting and also review attestation engagements, direct reporting and attestation engagements, both provide limited assurance, but the source of the information is different. So for attestation, the information is from management, but for direct reporting, the information is from another reviewer from management. So for example, an auditor. So the source differed. Attestation is from management, while direct reporting is from either an auditor's work or an independent reviewer's work. Very key to take note. So those are the types of review engagements, and that I think it's a bit clear. Any questions on that or clarifications? All right, if we don't have, let's run. So we want to look at the difference between attestation and direct reporting engagement. So for attestation engagements, to attest means to confirm or to vouch for something. To confirm or to vouch for something. So in attestation, the practitioner or the chartered accountant that performs certain procedures or actions have been required to do that by management without evaluating quality or effectiveness. So an attestation engagement is an engagement provided by management with data from management to be performed by that same practitioner without evaluating their quality or effectiveness. is just for him to provide his conclusion and attest or vouch to the fact that their data has been prepared based on either an applicable framework or a provided jurisdiction kind of review. So, for example, a practitioner could be attesting that payroll controls were followed according to the company's internal policy. So that's an attestation. They give us payrolls, he checks the approval limits, he checks the payroll preparation, he checks the computation, he checks the deductions, he checks the remittances. They are in line with company policy and external regulations. So the focus of attestation is ensuring it is well done and not it was done well. What does that mean? It is done, it was done means what management has proposed in their policy is done, but not attesting to the fact that it was done well. There are two different conversations or two different things. You did something is different from you did it well. Doing it well is an assurance engagement. Auditors will say, oh, okay, the financial statements are prepared well. That is attestation. That is assurance. But attestation is that it was done. I vouch that it was done. So an example is that payroll controls were followed according to the company policy. Simple. That's an example of an attestation engagement. Then for direct reporting, could speak to the fact that a practitioner provides a special report based on independent examination of financial or non-financial information, either from auditors or external independent reviewers, like we said earlier. And that report gives limited or negative assurance on whether the subject matter is fairly stated. So, for example, a direct reporting could produce a review report expressing limited assurance that quarterly financial statements are prepared in line with IFRS. So, auditors could have looked at a previous year's financial statement, and before those same auditors come for the current year, management could get a practitioner to help them check their quarterly financial statement to see if it's in line with the applicable framework. So they could be in tandem and in sync with what the IFRS demands for a full year audit. So that's what a review report or a direct reporting engagement, or an example of one of it amongst others. So for assurance, the job of the practitioner is to affirm, confirm is to vouch. But for direct reporting, the job is to describe. So attestation affirms actions done as prescribed, either based on policy or SOPs, while direct reporting describes findings after independent reviews have been performed. Very important. And the essence of this is that an attestation confirms performance of something done, while direct reporting, it's an independent, limited assurance opinion on what an external reviewer has done. Very key. All right. Any questions so far? Any observation? I'm running very fast. I want us to see how to finish these concepts in this class. Excuse me. All right. So let's go to the third session. We're looking at due diligence engagements. Due diligence engagements. All right. So due diligence engagements are predominantly direct reporting assignments where the practitioner or the chartered accountant investigates the accounts, operations, strategies, prospect of a target company, usually before an acquisition or a merger. So due diligence engagement, like the word due diligence, you are performing due diligence, ensuring that critical checks are performed before an action is taken by management around accounts, investigating operations, prospects of a targeted company that want to be bought or be merged with. So due diligence engagements. Chartered accountants that are experienced in these areas could be engaged for such services. And the objective is to provide factual independent information that helps the client, management, or the engaged company, whether to proceed with the acquisition or the merger, or whether to propose a price that is reasonable, higher or lower. So that's generally the essence of due diligence engagements. And the scope of work around due diligence engagements is more of like finding out more in a business, do us more investigation, critical checks on a business, check their financial performance, number one, We have a mnemonic here that could help you understand what the due diligence job entails, or examples of it. Number one is a practitioner could be engaged to check the financial performance or position of a company. Number two, okay, so the financial performance could involve reviewing past financials, ratios, forecasts, budgets, cash flows to assess stability and performance of the business. Number two is around operational issues. The practitioner could be engaged to examine contracts, customer retention, staff turnover, warranties, efficiency gaps, effectiveness gaps, economic gaps in the company's processes and systems. So operational issues are also areas a practitioner could be engaged to check for company lapses. Number three is management representation. A practitioner could be asked to look into management claims, issues with litigation, issues with court cases, tax dispute, compliance challenges. He could be engaged to investigate and critically review, such operations, to review such engagements and ensure that management representations based on that targeted company are well presented and management does not make any, or his client does not make misinformed decisions that will boomerang later after the acquisition. And that's why they are due diligence engagements. Number four, a practitioner could be asked also to identify assets, hidden tangibles like brands, customer list, patents for proper evaluation and also revaluation. So identification of assets, especially intangible assets around goodwill, brands, and patents, a practitioner could be engaged to provide serious context and insights into these critical areas. Another area is the advantages and benefits, speaking to the reasons or the advantages for due diligence engagements. Is to estimate expected synergies around cost savings, economies of scales, and to see if that project or that targeted company is viable. So a practitioner could be engaged to check what could we stand to gain if we merge or we acquire this company. Very key. Also, he could be engaged to check burdens or costs around potential one-off costs like redundancies, reorganization, merging with the culture of the former staff and the new staff. What are the burdens? What are the costs? We need to bring them out for us, bring it to the fore. So there could be benefits of using an audit firm to carry out such due diligence service engagements. It could help save management's time and also ensure expert execution where such audit firms have that expertise. Most audit firms have stratified departments. You see, most audit firms, they have audit and assurance, they have financial reporting, they have mergers and acquisition, they have consultancy, they have liquidation and bankruptcy. Most big fours have several specialized units. And this helps segregation of duties and division of labor, and also expert concentration and execution of the job, in the sense that where your area of strength is, you concentrate and leverage on that. And specialization also, that's the word I was looking for. Specialization, it's what most of these audit firms do. You work with them, they ask you to specialize in a particular area of expertise. The benefits is that one of it is to build confidence for shareholders and lenders that the acquisition or whatever targeted merger or whatever it is they want to synergize was carefully evaluated by a professional. That's the benefit of using an audit firm that stratifies its services in such areas. So the key takeaway around due diligence engagements is that it helps you look before you leap. So for example, a pre-acquisition review to confirm that a targeted company is worth buying at the right price is what management could engage a practitioner or an audit firm to help them look before they leap. So they don't make costly decisions, and after acquisitions and mergers, they're like, so we bought wahala for ourselves. And that's the essence of due diligence. So generally, that's what due diligence engagements are all about. Any questions, contributions, observations? Please bring them on freely if you have any concerns. We're trying to run, and that's why I'm very, very fast. All right, so let's look at the next section on due diligence reports, the reporting on due diligence engagements. So due diligence reports don't have formalized strict formats or contents or templates. Actually, the core or the contents of any due diligence report is based on the engagement letter, that is the agreement between the practitioner and the client. And they generally follow some basic or generalized formats around number one, the introduction, the executive summary. What is the summary of the engagement? What were we asked to do in summary form? Also, the overview of the targeted company or the acquiree company, the merger company or the company that they want to merge with. So highlights of key findings and red flags could be incorporated in the introduction and exit summary after the job has been done. And number two, the main report section talking about common findings and contents around, you could see an acronym I provided. And this detailed review could be around financial analysis, talking about the historic and audited accounts of the targeted company. It could be around litigation and legal review, looking at complex areas around court cases, pending issues that could be of serious concern to the current company or the acquiring company. Also, obligations around loans that have been taken, leases, guarantees, any obligations or liabilities that could form a bottleneck could be part of this report. Corporate governance and compliance challenges, findings from the practitioner. SWOT analysis, speaking to the strength and weakness which are internal to the company, the opportunities and threats which are external to the company. And those analyses could be in the body of the report. Looking at suppliers and customers, their key relationships, very important. Creditors and debtors, payables and receivables could be part of the report. Employment issues, pension, redundancy, fair pay, and equity issues around employment and retention of staff could also feature in the report. The executive team, who are the key management in that target company, the board of directors, the committee members could feature in the report. And also management representations around audit engagements and documented engagements between auditors and the company could be featured in this report. And finally, the third one, so if we look at introduction, content and findings, then the appendices could have supporting documents around statements, contracts, financial schedules, and whatever computations that don't come with the body of the work could be attached in the appendix. So that's a typical format of or an order that you could follow around introduction, key content and findings, and appendices. A report format could be structured for a due diligence report. So for example, before acquiring X, Y, and Z, ABC PLC's auditors prepared a due diligence report analyzing XYZ financials. They analyze the contracts, they analyze XYZ's key staff, and advise whether the 2 billion offer price they wanted to buy XYZ is justified. So that's an example of a due diligence report format. All right, so let's look at the International Standards on Review Engagements 2400, very key standard. International Standards on Review Engagement 2400. And this speaks to review of historical financial statements. So the objective of this standard is to obtain limited assurance, which is moderate confidence or comfort, mainly via analytical procedures and inquiries like we've spoken about, but not detailed or substantive testing. So that's the essence of ISRE 2400, and it guides the operationalization of the review of historical financial statements. And this mnemonic will help you remember that the ISRE 2400 helps to obtain limited assurance, not reasonable assurance, limited or even no assurance, and also to help perform inquiries and analytics, not detailed or substantive testing, and also make a conclusion on whether anything suggests misstatement or a deviation from the normal. So that's what the international standards on review engagements, on review of historical financial statements guided or is guiding us to provide. So the principles in handling review engagement speaks to skepticism and ethics. And after skepticism and ethics, the practitioner has to employ this in that engagement. Then proper planning. Proper planning. Proper planning is a key feature of the review engagements an auditor should perform. So he has to be skeptical. He has to properly plan the engagement. He has to provide his professional judgment. Then he must have evidence, sufficient, appropriate, not audit evidence now, appropriate evidence to show that he has done to some extent the work that he's asked to do with some analytics, even though not substantive testing, to arrive at his conclusion. So these types of review procedures, the practitioner needs to understand the business he's analyzing or reviewing and the industry. He also needs to be able to compare current and prior period results and data. He should be able to perform ratios analysis and trend analysis to come up with some reasonable reviews. He should be able to inquire about accounting policies, board decision, minutes of meetings, issues around subsequent events, and also obtain management representation in writing. He could also evaluate going concern to review some of these things. And the reporting outcome could come up with an unmodified opinion speaking to a reporting statement around saying to management that nothing has come to our attention that anything has gone wrong with the financial statement. So it could take that form of reporting to say he's not modifying anything in his report, or he's trying to assure them limitedly by providing limited confidence or comfort that nothing has come to our attention to warrant there's a deviation from the normal in what we've reviewed, which is a negative assurance. And he could also report around qualifying his opinion. You can look at qualification as negative in the area of speaking to a material issue around wrong inventory valuation. Maybe a company is using LIFO and the policy states FIFO. So he could qualify his report using qualification now to say that something has gone wrong. Inventory is not managed properly or valued properly. So the reporting could take any of this form to say nothing has come to our attention, or qualifying it by saying something is wrong and it has come to our attention. And he could also modify his opinion by speaking to the pervasive or limitation of scope. We cannot provide an opinion whether they are doing well or not. And that's what the modified adverse opinion speaks to. So, for example, a practitioner could be engaged to review the EF's limited 6 months financial statements. And from his review, it reveals that no material misstatement has come to his attention, and the report gives limited assurance, but not an audit opinion. So I've reviewed the 6 months financial statement. The reviewer will say, or the practitioner will say, under the international standards on review engagement 2400, and he will say, okay, from what I've reviewed, nothing has come to my attention, but I'm not giving you reasonable assurance. I'm just saying nothing has come to my attention that will warrant me providing a qualification or pinpointing that something has gone wrong, and I cannot vouch for the financial statements provided for my review. This is key to understand in the ISRE 2400 on the review of historical financial information. All right, so take note of these 2 standards. I had to break them down because they feature in the AAA-F question. The examiner brings them practically. So please take note of it and understand these concepts very seamlessly. The second standard on review engagement is 2410, review of interim financial information. And the examiner brings this most of the times. He tests this area. So the review of interim financial information applies to mid-year reviews performed by the external auditor of the entity. Excuse me. Pardon me. I've started experiencing cold here, and my system really reacts to code. All right. So I was saying that International Standards on Review Engagement 2410, review of interim financial statements, applies to, like it said, interim financial statement. When you hear the word interim, you know it's not full year. So there are reviews performed by an external auditor for mid or half year prepared financial statements. So the cost set steps in preparing this information is for the practitioner to understand the ethical and quality control around the interim financial information or financial statements review. He needs to plan and agree engagement terms with the client. He also needs to inquire and analyze the interim data provided to him. Then he also needs to assess going concern issues and subsequent events that could impact some of this interim financial information he's reviewing. He also needs to report with limited or negative assurance, not reasonable assurance now like an audit. So this is also a review engagement that does not require full scope audit. It's just half-year financial statement. So he's reviewing, not providing substantive or detailed testing, but reporting with limited or no assurance. We could just say nothing has come to our attention that this 6 months financial statement has issues. And the review report must include, like the normal reporting, have the title, the addressee, have the identification of the interim financial information reviewed, management responsibilities, the same as it is in audits, full audits, the auditor's scope and conclusion, where is he restricted to, 6 months financial statements, and what is he concluding on. And also the statement of limited scope, speaking to no audit opinion expressed, just limited assurance or no assurance. He'll date his report, put his location or stamp, and sign it. So an example of the reports that could be provided could be an unmodified opinion, speaking to the statement he could make around, based on our review, nothing has come to our attention. Those are typical statements you should understand for review engagements. Based on our opinion, nothing has come to our attention that causes us to believe the interim financial information is not prepared in all material respects in accordance with IFRS. Very simple. He could modify his opinion around that. And if he's in doubt, he could qualify his opinion by saying, I found reasons. So, for example, non-compliance with revenue recognition based on IFRS 15, or non-compliance with tax remittances based on PITA, payee, or whatever it is. He could also qualify his report by saying there's limitation or going concern on certainty from what I've seen in the financial statements and reviewed. And he could also provide adverse opinion on not being able to provide assurance that nothing has come to his attention, and also not being able to qualify by saying he's restricted by scope and he needs further information to be provided by management. And you must understand the difference between these both standards, 2400 and 2410. And you could use the area of limited assurance, inquiries, trend analysis, and evidence-based performance around the ISRE 2400. So you could use the acronym LIGHT to speak to the engagement is provided by the practitioner, and he will provide his report and provide limited assurance. His inquiries, his analysis are not detailed and substantive, but it must be evidence-based. So the LIGHT acronym would provide you with a way to remember the concepts around ISRE 2400. Then for 2410, the mid-year acronym could help you remember that management should provide data that the practitioner will use to do his inquiries, document his findings based on the yearly interim information provided, and he will review it with limited assurance provision. So it's a mid-year review, don't forget, and it's mostly interim financial information, which is 6 months that is provided in the International Standards on Review Engagement 2410. All right, so any questions? We just rounded up due diligence reports on the Audit-Related Services chapter. Any questions? Any observations, clarifications, or contributions? All right, we seem to be quiet. Nobody has engaged so far. I believe the content is a bit clearer than the study text. I've tried my best to see how to put it in very comprehensive and simple language we could understand. Okay, so let's look at the next unit. We just rounded off audit and audit-related services. So let's look at agreed upon procedures as a unit on its own, agreed upon procedures. So this first unit, we'll be looking at the nature of agreed upon procedures. The nature of agreed upon procedures. So as the word means, agreed upon procedures, agreed upon processes. AUPs are engagements where a client specifies the exact procedures or processes or systems he wants the practitioner to perform the work on. So what is the process of recognizing revenue? What is the process of settling creditors? Please help us review it. So those are examples of agreed upon procedures. Very, very simple. A chartered accountant could simply perform steps and report factual findings on procedures without giving assurance or an opinion. Just perform your reviews on a particular step and report on those factual, what he has found. So the client decides and the practitioner performs. The client decides, help us check payroll, review payroll. And the chartered accountant reviews only payroll. And the users conclude from his review. So the core features of agreed upon procedures speaks to agreed procedures around the client and the practitioner agree on what to check. So the client provides, I want you to check this. I'm skeptical about it. The chartered accountant helps him to check that area. The user's responsibility speaks to users interpret results themselves based on what the practitioner has checked. So he gives you a report and you're okay. This is how they recognize revenue based on IFRS 15. Okay, so you interpret whatever. He doesn't interpret for you. He doesn't conclude. He just does what you ask him to do. Agreed upon procedures. And the P part speaks to procedures only. No professional judgment, no conclusions, no recommendations, just professional judgment, no assurance given. And that's what agreed upon procedures are all about. And it's restricted. It's for restricted use, is customized for a particular client and his demands or his request. So the report is for those who agree the procedures only. It's not for publication, it's not for management or board meetings and all that. And also the outcome speaks to factual findings and they are not conclusions or opinions. Those are the critical points you should look at. Core features of agreed upon procedure. So for example, a bank could hire a chartered accountant to verify cash balances of a borrower, maybe a significant creditor. They'll tell him, help us independently now, an audit firm's chartered accountant, to help us check the cash balances of this so borrower. And the accountant checks the balances and reports findings, but he does not give assurance about the accuracy and fairness of those balances. He just tells, okay, I saw that the cash balance of this borrower is so amount. And that's it. That's what you asked me to do. And that is an example, a hypothetical scenario and an example of agreed upon procedures. So we have the International Standards on Review, Related Services 4400 that guides agreed upon procedure engagements. So every agreed upon procedure engagements are guided by ISRS 440. So the first step is to have an engagement letter stating the agreement of terms between the practitioner and the client. And it must include the nature and purpose of that agreed upon procedures. It must be clearly stated in writing in the engagement letter that it's not an audit or a review, but it's an agreed upon procedure. Number two is the procedures that is agreed upon must be specified in that engagement letter. And the exact checks to be performed on those procedures must be stated. And also the output, the form of report that should be contained and should be produced by or provided by the practitioner only must be meted out in the engagement letter. Also the limitation, restriction of the reports used to agreed parties. Who are those that will use it? The users of it. the restriction must be stated in the engagement letter. So the work process around this kind of agreed upon procedures, even though it's less extensive in coverage and scope than an audit, it still involves planning the procedures by the chartered accountant. He has to plan the procedures. He has to also collect evidence as per the client's instruction on what to base his report. He also needs to conclude drawing from what he has gathered, but not providing maybe template conclusions, but from his factual statements, it should be drawn from evidence and also report those factual statements only. So, agreed upon procedure speaks to an agreement between the client and the chartered accountant without no assurance, and it's a private arrangement. So you could see agreed upon procedures and explain it around an agreement between a client and a chartered accountant that provides no assurance, and it's a private arrangement restricted to a few users. So that's the key tip that will help you remember, because the essence of agreed upon procedures engagement do not express opinions on their findings or provide assurance. They are purely factual and meant for specific users only, and they are tailored needs. And that's the essence of agreed upon procedure. So, for example, ABC Limited engages a practitioner to confirm his supplier's balances as at 31st or 30th June, half year. So the accountant or the practitioner checks the records and reports discrepancies, but does not conclude on fairness or accuracy of the report. So that's a typical example or hypothetical scenario on an agreed upon procedure. All right, so that's the nature of agreed upon procedure. Any questions? You guys are scaring me. You guys are quiet. What's going on? Everyone is quiet. Is it that the thing is sinking very well?
Well, with you, sir.
Really? I just seem as if I'm talking for over an hour. Nobody is saying anything. I just hope the slide is there very clear, because I was reading the study text and I was like, these things are complex. So how do I communicate
every morning
this
when
thing?
you post that 21 days to go, 19 days to go, is well.
I learned it from Platinum Gold. I use Platinum Gold for my CR, SFM case study. In fact, they helped me score 78 in case study. And that tuition provider in Lagos, they are very good. So what they do is they always scare you. They will always send you mails. In the morning, you just email 21 days to go. Your heart will be beating. Gee. So the owner taught me that. So when I started tutoring, I used to do my students that I'll start doing countdown to the day of the exam. So it helps you, keeps you on check to say, okay, like somebody said on the case study platform that, so anytime I see that countdown, I'll just run and carry my book straight. Whatever I'm doing, she'll pick her book straight, But it's a way to remind us that exams are coming. Whatever you are doing, try to put yourself in check, Or should I stop it? Is it scaring you guys?
No, it's okay. It's okay. Very okay.
Okay.
Very okay.
All right.
Just tells us we have a lot to do, and you tried a lot. It's not always looking like it's a lot. It's always like that until you get to exam halls for Misha.
Until you even write the exam, you always feel like, see, I've not done anything. That's how I can always make you feel.
Exactly.
I've not read, I've not covered, I've not practiced, you always have that sense of inadequacy. But then, it's a feat that you always have. You beat it. You have that feat. You pass the exam. So that inadequacy will be there, but then it sprouts you to read more, practice more, and put in the grind. So, well, I feel better now. At least I'm speaking to people and you are responding. So thank you for that engagement, Sammy. All right, so let's run. I want us to finish this chapter today, because officially, yes, please. Yeah.
Is there any special format in reporting the agreed upon procedures?
Okay.
Is there any format reporting the
agreed upon procedures? Okay, no, there's no special format, but then just go through the normal introduction, which has to do with executive summary, summarize what you've done. Then you have the detailed report, then the appendices. Just that general reporting template will work also for agreed upon procedures. It just depends on the practitioner's discretion. So just use your discretion. Just make sure that what you are reporting is comprehensive to your client.
Okay, sir.
Yeah. All right, thank you. I feel better now because I've been speaking, and I thought at a point I was on my own. So I'm glad that the slides are at least a bit more comprehensive than the study text. Okay, so let's look at the reporting on the agreed upon procedures. I think that's the question Mr. Mike just asked now on reporting. Okay, so the core idea of reporting on AUPs present only factual findings. Actually, we've said that over and again. There's no assurance whether limited, so no opinion. It's a restricted use report. It's meant only for parties who agreed the procedures and directed the practitioner on what he should do. So the key phrase around this, report facts, not your opinion. What you found, just report it. And the essential contents of an AUP report speaks to, we could use this in mnemonic, but I don't think I can remember this mnemonic. I tried something, but this one I don't think it's too long. But then if you use it, it's fine. But just understand the concept. The auditor's insight should inspire professional, limited, factual, ethical, neutral, restricted report. That statement you may not be able to remember, but then I just added that to help you remember that the report should inspire the professional, which is the practitioner. He's providing limited assurance based on facts and ethics. He's neutral because he's not providing an opinion, and he's restricting his report to a particular audience or user. So normally you have the title of the report. It's clear with appropriate heading, and you report, for example, report on the factual findings. You address it. Usually the client who engaged the practitioner is the addressee. You identify and state exactly which financial or non-information was tested or was agreed upon. What procedures were agreed upon. You identify that in the report. You state the agreed procedures. Confirm that the procedures performed were those you agreed upon with the client. Then you have the guide, the standards, ISRS 440. You state what was done under the standards and the relevant national standard that guided your reporting. So the practitioner's independence has to be declared. If the auditor is not independent, where applicable, but he has to declare his independence and what he was asked to do based on the scope. And also the limitation of purpose. The practitioner has to indicate the purpose for which the procedure was performed based on management's prompt and discretion and request. He also needs to provide facts and findings by listing the procedures performed, what he did based on the evidence he gathered. He has to have evidence. His factual results, including exceptions or errors he found, negatives or positive. Then the exclusion of assurance, which is not part of the agreed upon procedure. He needs to state clearly that no assurance is expressed, is not an audit or a review, it's just an agreed upon procedure. He also needs to note that on the further work he's supposed to perform, he needs to mention that additional work might reveal other matters that the agreed upon procedure restriction did not help provide. He also needs to state that is for restricted use. The report and the output is to parties who agreed the procedures and not for maybe all management team. Agreed upon procedures could be asked or requested from maybe an MD or just a committee on the board, maybe an audit committee or risk committee, compliance committee. So those users are the people that will receive the output, depending on where the request is coming from. Then the reference on scope, he needs to clarify that it relates only to the specified elements, items, and data examined as requested by that specific user or group. So for example, XYZ Bank engaged an auditor to verify the loan balances of 10 major clients, only 10 major clients. So the report will have this output. He needs to identify the clients he tested, 10 of them, list each verification procedure and factual reports he derived from those procedures. He also needs to state that this is not an audit or a review, and he restricts the report to XYZ users, whether XYZ audit committee, XYZ remuneration committee, or management committee, whatever it is. And the essence of AUP reports is to bring out facts only. No assurance for limited users, and it provides clarity, not comfort. Comfort is assurance. Letting users draw their own conclusions from his professional expertise he has injected in that engagement or that procedure. So the key point on agreed upon procedures is provide facts, not faith. Faith talking about assurance or comfort. No. Agreed upon procedures reports any of the outputs on agreed upon procedures. Tell whatever it is. It does not provide assurance. So please take note of these key findings so that key terms so you can understand how to navigate this properly under exam condition. All right, it is 9:04 now. Okay, so we have to go on break.